Hi, Sam.
Hi, Sabine.
So good to see you. So today I'm with Sam Evans, who is the partner, founding partner, managing partner of Eos Venture Partners. So Sam, thank you very much for being with us today. I know you for quite a while, since I set up the Startup Accelerator 6 years ago. And at the time, you actually set up your fund to actually invest in InsurTech startups. So I'm so thrilled to be speaking with you today around the world of corporate venturing and helping our listener to understand what that is from the investor viewpoint. So thank you and welcome.
Yeah, no, thank you for inviting me.
So Sam, I would like to start with an introduction about you. Who are you and what got you into investment?
So I founded Eos in 2016 along with my two partners, and the genesis came from having worked in insurance for 20 years and experienced firsthand the pain points that the industry was experiencing as it made that sort of slow, painful transition from a very legacy-driven, manual-based insurance process into the digital world, it was a nice sort of combination of good timing, right place, right time. We were one of the first, if not the first, specialist insurtech investor. So we created Eos to focus exclusively on insurtech. And importantly, and maybe we can come on to this, sort of key to our philosophy was working in partnership with the industry rather than adopting a sort of pure challenger model, which was where we saw the greatest value being created.
And so what got you really interested in that actually topic, Sam? So what got you into investing? Because you told me you have 25 years of experience. You are bringing as well into investing.
So I think, we were starting to, it was very early stages. We were starting to see some exciting companies, businesses like Neos in the UK, which got acquired by Aviva, was one of the companies that we invested in even prior to launching our fund. So we were excited by the opportunity. There were companies doing things completely differently, leveraging technology, looking to really transform what had been, as I said, a very encumbered industry that had really struggled to innovate. So it was the combination of the emerging startups, the incumbents, the big insurers starting to think more seriously about their digital agenda and their innovation strategy, and trying to position Eos as a bridge conduit between the two worlds.
And so tell me a little bit more around Eos Venture Partners and where you are. So you have colleagues working with you, and you guys are covering a number of markets where we have InsurTechs. So where are you located and who are you serving?
So we've got a team of 8, I guess, core investment professionals, and then a broader network of supporting people in our advisory council. We're based in London and East and West Coast of the US. It's 4 partners, 2 here in the UK, 2 in the US. We're investing globally. So at the moment we have 11 portfolio companies that are split between the UK, Europe, Asia, and the US. So we've always been from the beginning very committed to having a global focus, because we see InsurTech having a big impact across the world in all the major markets. So I wanted to have exposure as broadly as possible, albeit we do have a sort of weighting towards UK, Europe, and the US, where there's obviously a lot of activity. And in terms of our model, as I said, we were keen to create Eos under the sort of overarching principle of partnership-driven approach, working with the industry. So all of our limited partners, that's all of the investors into our fund, come from the insurance industry. So we have insurers and reinsurers from the US, Canada, UK, Europe, and Asia. And effectively, we're working with them. the model that we've developed, we call return on investment and innovation. And the extra I really gets to the heart of the strategic partnership model that we've built with our limited partners. So return on investment, obviously you'd expect for a venture capital fund, we're looking to generate top quartile returns over the lifetime of the fund. But as importantly, the additional I is a return on innovation. And for us, that's helping our limited partners, accelerate adoption of their innovation strategy. So leveraging Eos's position in the market to identify opportunities to work with, InsurTechs, building relationships with our portfolio companies to get traction on both sides, becoming a part of their innovation strategy, part of their innovation team, with a view to helping them, accelerate those core objectives.
And so your mission, goal, strategy, short-term and long-term, you mentioned that working with your limited partners who are located in the US, you said Asia and Europe, you are focusing on a variety of outcomes and results, including innovation. So how are you measuring yourself and how are the other partners measuring themselves when you look at the 11 investments you have actually achieved?
Yeah, so from a financial perspective, our overarching goal is to achieve a top quartile return for the fund. When we're making investments, we invest at Series A stage. That's our sweet spot, our focus. We can do a little bit earlier, a little bit later, but Series A is very much where we like to focus our attention. So we're looking, for a 10x type return for each individual company. Obviously, it's unlikely that you get that across the portfolio, but that'll balance out hopefully to a top quartile return performance. So that's the objective from a financial perspective. The second key goal is how much traction we can drive with our limited partners. And we look at that, there's 4 separate areas that we focus on. The first is identifying investment opportunities. So that can either be acquisitions or investments, co-investments alongside the fund. We've established 2 vehicles to enable our LPs to co-invest alongside the fund where they have particular strategic interest in the underlying company. So we're looking to find those opportunities. As the sector matures, there are opportunities for larger players to acquire, obviously the InsurTech businesses, to bring that capability in-house. And we've done a couple of those with our existing limited partner base. The second area is around establishing cooperation between the LPs and the portfolio companies. And I think pretty much all of the, if not all, the vast majority of the portfolio companies are working with the LPs in one way or another. So that can be provision of capacity. So we're helping drive top line growth and revenue for the investor, but also obviously traction for the underlying company. Or it's a provision of services capability that's relevant for the LP. The third area is a broader sort of looking at how much connectivity we're able to drive for the LP. So I looked at one recently. In the last 18 months, we've introduced over 100 companies to this limited partner, and that's across all areas of the value chain. So it's looking at product innovation, new distribution channels, underwriting capability, leveraging alternative data to improve and enhance underwriting through claims. So full spectrum of the value chain. We're looking to identify partnership opportunities, commercial opportunities where they can work with third-party capability to accelerate their objectives. And then the final area is around sort of supporting their innovation strategy. So we've been quite involved with a number of our limited partners, helping them develop, where and how they should be playing in the innovation space, and what does that mean for their short-term priorities as well as their longer-term, outlook. So really embedding, innovation within their core BAU strategy. We do a lot of thought leadership around the key trends, key opportunities. What does that mean for the for the limited partner and what opportunities exist. So it's a sort of catch-all for market trend analysis, thought leadership, deep dives into specific verticals to identify opportunities. So to catch that, we're looking really to drive as much innovation activity as we can, but in a meaningful way. So it's not about theoretical opportunities, it's about practical use cases, with real companies that you can pick up and use today. And then the third overarching goal for EOS is around ESG, and which we believe is a critical part of our business model. We see fantastic alignment between the objectives of ESG insurance and specifically InsurTech. So over the next 10 years, we have a goal of positively impacting 500 million lives globally.
That is impressive. 500 million lives globally being impacted by aligning startup thinking with corporate thinking through ESG, meaning environmental, social, and governance drivers, which a lot of corporations around the world are looking at much more closely today. And those are based on what we call the UN SDG, so United Nations SDG, so Sustainability Development Goals. So looking at the goals and then aligning metrics to it. And through that, identifying opportunities to improve people's lives. So very impressive. So that takes me, looking at disruption, Sam. So what are the topics you are looking at? What excites you and where are you investing your money?
So, there's so much happening. It's a super exciting time. A couple of key areas for us at the moment. One is in relation to the gig economy. So, it's a classic, very difficult to properly serve that with traditional insurance solutions because they're not usage-based, they're not connected, they're backward-looking, they're not real-time. So, it's a huge growing market, and obviously with the pandemic as well, seeing a move to more people using the gig economy, either from a leisure or work perspective. So it's global, it's growing quickly, it's underserved. There's a massive opportunity. We've already made investments in that area, like with Buckle in the US, which is working with rideshare drivers at the moment, food delivery, those types of that part of the gig economy, and providing 24/7 coverage across personal and commercial usage, embedded within the gig platforms. We'll do more in that space, I'm sure. Second area we're excited about is the ability to transition from protection to prevention within life and health. So rather than just, something bad has happened, here's a cash payment, actually, how can we leverage technology to get ahead of the events, to be proactive, to manage risk, to embed health tech, med tech. We're at the point now where we can have real-time monitoring. So if we know that somebody has, a risk of diabetes, we can provide, or the insurance policy can provide, real-time glucose blood level monitoring to prevent, the onset or deterioration of the condition. So I think as a general comment, life and health is maybe a little bit behind P&C and commercial in terms of its development over the last 5 years. So I think there'll be a big shift. Obviously, again, the pandemic, has heightened focus on health, and also moving away from, traditional sort of to where you have to physically visit the doctor or the hospital. We're now in a world where in certain instances that's no longer necessary. So a combination of all of those different things I think is going to be super exciting. Third area, there's a lot of new emerging risk classes. Cyber, I guess, or you probably wouldn't call it new, but it's again an area where there's a significant amount of activity, threats developing all the time. A lot of players in the space. We've made 2 cyber investments in Alpha Secure and CyberSmart, so already active. But I think just the tip of the iceberg. And again, we like business models with a sort of proactive risk mitigation and prevention strategy built in. So, you're looking to reduce claims frequency and severity through proactive adoption of security measures, but really working with, again, underserved parts of the market, particularly SMEs that can't access maybe the more expensive solutions that the larger companies can tap into. So yeah, lots more activity there. And then the final area would be around sort of connected insurance. So connected motor, it's the use of IoT. That goes across commercial lines as well as personal. We've just made an investment in a connected motor play in the UK, a business called Ticker, which it's a digital-driven insurer which is providing connected motor insurance and taking that from what's been a very sort of niche focused part of the market into the broader motor market. So opening up about 26 million drivers, I think it is, in the UK. And we like those models because there's a nice ESG component because it provides insurance to people that maybe struggle to get affordable coverage. It improves safety because it's improving driving quality. It's identifying hotspots, accident hotspots and the like. And then from an insurance perspective, you're getting better underwriting results because you're able to use the data to both enhance your risk selection and pricing, but also through the improvement in driving behaviours, you're lowering your claims frequency and severity events.
So, I like the different topics you mentioned. So when you look at gig economy, I've had quite a few conversations around the digital nomad, one of the segments, which is gig worker. And today, when you look at us being able to work potentially from all around the globe, we potentially are all digital nomads, probably doing more than one thing, which means that the insurance we are used to buying may be very different from what we are going to buy tomorrow. So a massive area for opportunity. But at the same time, as you saw, Sam, with the current or the past 18 months, a lot of insurers have taken out capacity within, the gig economy and the SME or small medium enterprise market. So it would be interesting to dive into that. The second area, health and wellness and prevention. Again, another market which has shifted during the course of the past 18 months with a big focus, I think, on behavioral health, mental health, emotional health, and looking at us as, healthy people, balanced people with the right work-life balance, and seeing how, the insurers can be a partner to help us do things better. The two others around emerging risk, has been one of my big topics. And I think our opportunity with sustainability and ESG is to look at how we design the new product and services of tomorrow, actually, by combining understanding the emerging risk that may come upon us because of the new world we are living in. And connected, smart home, connected vehicle, definitely big topics I can see where innovation, InsurTech, fintech in general, even wealth tech and health tech are going to have a major impact. So when you look at your topic, Sam, and the past 18 months, have you had to shift anything? Is it part of the shift around your in innovation or investment thesis?
I think as a general comment, and I think some of the big sort of strat houses have looked at this as well. The general view is that the pandemic has accelerated, the industry's adoption of digital by at least 5 years, which is quite a staggering statistic or measure, and we're certainly seeing it. So things that were nice to have are now suddenly an essential. Pretty much all of our portfolio companies, apart from the ones where the business model, obviously they've been connected motor, when people were not driving and the learning centres were closed, that had an impact. But as a general rule, the demand for the services of our portfolio companies, has increased significantly. So we're seeing it in real time, and the sector, if InsurTech as an overall, it's 5-6 years old, depending on when you set the starting point. But it's maturing, and I think the pandemic has really sort of accelerated that maturity as well. So we're sort of seeing like a flight to quality, both in terms of fundraising. Like the number of overall fundraising levels are increasing, but they're being more and more dominated by a smaller number of companies raising large rounds. I think in the first half of this year, 5 billion of the 7 was 50 million plus rounds, something along those lines. So definite flight to quality in terms of funding, but also in terms of the insurers, in terms of how they're using these solutions. They want things that are ready to go. They don't want to. They're not interested in proof of concepts anymore. They want solutions they can drop in, and it's going to have a meaningful impact from day one. It was a lot of InsurTechs were going to struggle and fail. That was going to be part of the natural evolution of the sector. I think COVID has accelerated that to a certain degree, sort of due to that flight to quality and focus on those that are doing particularly well.
So is it fair you have seen consolidation, some startups maybe joining forces with others, as you say, some dropping out from the map? We have, I've seen some of my portfolio startups because of COVID and being B2B, B2C, being actually disillusioned in some ways because the investors also focused on investing on the existing portfolio startup to actually help them go to the next phase. So have you seen some shifts within our sector and our InsurTech?
Yeah, definitely. So a lot of two types of M&A that we're seeing: incumbents acquiring InsurTechs, and that can be both because they're very successful, and in the traditional sense, and that drives a great exit, but also in the sense that there's a lot of businesses out there that have good people, good technology, but it's just so difficult to scale in the current environment. A bigger player can pick up that team and the capability and drop it into their business and maybe get some quick wins. So there's definitely some sort of distressed M&A activity. And then the second component is also, yes, as you said, InsurTech and InsurTechs coming together, where it makes sense to leverage respective skill sets and capabilities, maybe create a more robust business model, or slightly younger, InsurTech joining a slightly larger one, where they can bring either something a little bit different, either from a technology, geographic, product perspective. So yes, a lot more M&A, which is good. And as I said, there is still a significant amount of funding being deployed. The first half of 2021, I think, was more funding than the whole of 2020. So we're still on a very, very significant upward trajectory in terms of appetite and capital flowing in. A lot of listings in the US, SPAC market's still active. There are some challenges there, and a lot of the listed InsurTechs are trading below their IPO price. And I think, some of the SPAC activity is slowing, but again, it's a natural sort of evolution of the sector. We were in an environment with inflated valuations. It was sort of you could see the InsurTech bubble sort of concept. I don't think it's burst, but it's deflated. And again, that's not necessarily a bad thing, because a sector has to, over time, come down to the lots of long-term benchmarks and sort of trading levels that you'd expect in any sector. So it's all part of the maturity of InsurTech as an investment sector.
Yeah, I mean, to echo some of the numbers you were highlighting, I think we are today around now at 10 billion invested in InsurTech. Prediction is that we probably reach 15 billion by the end of the year, so 2021. Last year, we had around 7 billion invested, so we are doing much better. And as you said, it's all going probably from the bigger players. Last year, 95% of that funding went to the large InsurTechs, which today, some of them have become unicorns, right? Or did their IPOs. And one question I have for you, can you actually explain for our listener what is SPAC and why people would use SPAC as a investment mechanism? Because I get that question a lot, Sam. So it would be great if you could explain it.
Yeah, I think it's quite a complicated topic, but it's another route to listing. And it's sort of a slightly, for me anyway, slightly bizarre sort of concept, but a lot of, very well-respected investors raise money, and it's almost like a blind pool in the sense that they raise the capital and then they're looking for businesses that they can effectively combine with the SPAC and then list. So there's different pros and cons depending on the business and the timing and the state of the market, the pricing, what you have to give away via the SPAC route versus listing directly. But it's potentially a quicker route because you don't have to go through the traditional listing process if you go via a SPAC. So I think it's very dependent case by case for each individual company as to what makes the most sense. But yeah, it's going to be there's I think there was certainly between 50 to 100 billion of capital that's sitting within the SPAC market that if it's not deployed will be returned to investors. So that will keep some momentum, even if the IPO markets are maybe a little bit more challenged than they were in the past.
Interesting. So now I'm going to tease you with a snappy word. So I'm going to tell you a word. I would love for you to give me an answer, and then it would be great to actually see how they fit together in our world. So technology.
InsurTech.
Behavior.
Founders.
Innovation.
Slow industry.
And regulation.
Complexity, but also opportunity.
So when actually you look at industry and regulation, so insurance as an industry, or when you look at even at the banking as industry, finance in general, we are highly regulated. And when I look at InsurTech coming into the sector, sometimes they can do it just with the tech. So therefore, they don't rely much on regulation. But often it just plays catch up. And the result of the industry we are living in, which is insurance, really highly risk averse, is that they take the time to make decisions. So how have you been countering that for your portfolio startups?
So there's two parts to that. So from a regulatory perspective, I mean, clearly, insurance is very complex, and given the breadth of different, the range of products from gadget insurance for £2 a month through to insuring huge construction projects, just shows the diversity of the industry. And that was one of the reasons, by the way, that we went for a partnership-driven model rather than a challenger-type model. I think fintech traditionally has been more challenger, but and there's a few examples of that. But even within, even the challenger models within insurance are still reliant on reinsurers for capacity. So, the vast majority of InsurTech models are driven through a collaborative approach, working with at least one part of the industry value chain. The flip side to that, though, is, incumbents definitely shouldn't see regulation as something that's going to protect them from, new entrants. We've seen just within our small portfolio, companies moving from an MGA into a full stack model. So Buckle, for example, in the US, has acquired two now licensed insurance entities. So it's now got a full balance sheet to sort of look at how it can optimize economics across the value chain. One of our UK companies at the moment is structured as an MGA. They're exploring options to do the same thing, to move into a full stack environment. The regulators have been very supportive. We've got the FCA sandbox here in the UK. Other jurisdictions have adopted something similar. So, there's appetite within the regulators to encourage innovation. So, I guess, whilst you have to acknowledge it's a hugely complex area, and it takes a lot of time to work through all the regulatory requirements and complexities. And it's worth noting, particularly in the US, where it's really 50 countries rather than one. And there's a lot of different requirements at the state level, which is one of the reasons why it's so difficult for companies to enter the US market and just expect to adopt their traditional model. So it makes it certainly adds complexity and challenges, but the InsurTechs are easily able to overcome those. And they're moving up the value chain, taking more of the economics. So I think we'll see that trend continue. And then the second part of your question was around sort of, I guess, adoption within the industry. And we see this a lot. And it's I think as you said, insurers are coming from a sort of naturally risk averse environment where decision by committee, there's many layers between getting something done and a decision maker. There's little incentive to try anything new, so people sort of why would I put my head over the parapet and risk getting shot off when I've got my objectives and just drive the business as usual bus along the road. It has definitely shifted, and the better organizations are adapting quickly. I think a lot of realizing that investing directly into startups is very difficult, and not many are able to do that successfully. And many actually have been unwinding their sort of CVC type structures. They're just not natural investors in InsurTechs or any young technology business. Better to rely on specialist investors. But that's sort of, so the switch from less investing has sort of moved into thinking about partnerships, collaboration, and how large organizations can work effectively with young businesses. Because even when you get to the point of a decision, yes, we want to implement X, that opens up another set of challenges around adoption and how do I get through my 300-page IT security questionnaire that I would typically apply when I'm adopting a 20 million IT project versus doing £100,000 MVP of a particular concept. So it's challenging, but it's definitely shifting. I think I'd say it has shifted a lot, and the top 10%, 20% of insurers are going to realize significant benefit, and it's going to be very, very difficult for the remaining 80% to catch up.
Which takes me to a point you made, right? That when you look at corporate venturing, which is looking at how we scout for ventures and enable them to partner and collaborate with large companies, other companies, industry companies, other sectors, and in your case, investing in them. And then the second part, which is building growth ventures. When you look at corporate venturing, you just highlighted that a lot of CVC, so corporate venture capitalists, funds had closed down because probably mismatch around skill set, investment agenda, and probably alignment with mothership who are actually providing the funding. What is for you the definition? What has happened in recent months around corporate venturing? And what can we learn to do corporate venturing better in the years to come?
So, it's an interesting dynamic. So I think, as I was saying, the overall trends are, and again, COVID has been part of this, is that there is an increasing appetite to do more with innovation within the large insurers, certainly the ones that we're engaging with. So the desire is there, and and that's coming from the very senior levels. So often sort of sponsored by the CEO. There's a little bit of a disconnect between that ambition and the reality, and I think the majority is sort of struggling with this. But yeah, the demand is there. There's also increased awareness that it's not easy, and there's no point trying to apply my standard model in an innovative environment, because 9 times out of 10, people have tried it, it doesn't work. Yeah, that's helpful. Companies are also looking at the cultural aspects, and giving people permission to try different things, different ideas. We've been involved in some sort of internal hackathon type concepts, which has been really, really interesting actually. And the really good ones have been sort of encouraging the graduate level employees within the organization to come forward with ideas and business concepts. And we find it with one was a brilliant idea which is now being adopted as part of their strategy. So it just shows there's no lack of ideas within the organization. It's about providing a framework and an environment that encourages that innovative thinking. It's okay to have a bad idea. Not all ideas are going to work. Some things will fail. That sort of concept is quite alien within a traditional insurance organization, but it's shifting, it's changing. So yeah, I'd say overall, it's a much more positive environment. And I guess, maybe with the remote working has shown that, if you'd have said to an insurer, 24 months ago, your whole workforce will be working remotely and your business won't be impacted. Yeah. They laughed in your face. But.
Yes, and a lot of change had to happen during the past year. Some were prepared to go through that change, others were less prepared, but everybody learned from it that actually you have to answer customer needs and you have to adapt your processes to do that. And sometimes you can do it faster by using tech companies able to actually improve your processes. And the example you are giving us around graduates coming with innovative ideas because they feel it, right? They see it, they experience it. And so are much more able to empathize with the customer and come with those ideas. So very interesting.
Yep. Yeah, definitely. And your customer behavior, demands, the way they want to engage with, insurance, but, everything, it was already changing, but it's a fundamental shift that insurers will ignore at their peril.
So, what are the 3 lessons you've learned? If we can minimize them to 3 to 5, I say 3 because it's easy to remember. If you are looking at what you've seen in recent months around business model change, approach change. Usually we tend to categorize them into efficiency innovation, where, you're looking at your process, sustaining innovation, where we start looking at product and service, then game-changing innovation, which tend to be much longer, which is true business model disruption. What are the things you've seen? What are the lessons you can share with us you've learned in recent months?
So there's a couple of things sort of spring to mind, jump to mind. The first is in relation to ESG. Coming back to that topic, it's sort of important within reinsurers, insurers, investors. Every part of the value chain is increasing, which we find super encouraging. And we're very committed to supporting business models that can support an ESG type goal or objective, particularly around closing the protection gap. But it goes right across it. The health topic that we covered, natural catastrophes, severe weather events. The world is facing some quite significant challenges in that regard. InsurTech can play a very important role, I think, in offering solutions and mitigating risk and preparing different demographics and providing them protection, in the worst case scenario. So I think we're certainly seeing a lot more focus on ESG. I think from our perspective as well, we're interested in InsurTechs that are risk-taking entities in some form, so often an MGA in the first instance, but the ability to control, at the end-to-end, as much of the value chain as possible, I think is important, and a lot of the benefit can be driven through improved, enhanced underwriting, leveraging those new technologies that we discussed earlier, but also there's a lot of data that's now available that can be deployed, and it's fundamentally changing, our view of risk and how it should be measured and assessed, and also moving it from a historical looking, always looking back perspective to actually real time assessment. So I think that's not so we will only invest in sort of an MGA style businesses, which is definitely not the case, but we like that part of the market. We're seeing some very encouraging trends, faster adoption. So I think we'll certainly focus on that part of the market. And then the third sort of general observation, it's a couple of things. I'm not quite sure if there's a clear third, but and I guess it's linked to my second comment. But there's a number of businesses that are struggling or require huge amounts of capital to be successful. So launching a direct-to-consumer InsurTech is very, very difficult. Obviously, the likes of Lemonade have proved that it can be done very successfully, but they had 500, 600 million of capital prior to their listing. So I think if you've got a huge balance sheet and you can afford that type of expenditure, that's fine. For smaller funds like ours, that's not the type of business model we're looking to support. And again, the incumbents are being very aggressive around pricing in personal lines in certain markets, or they're sort of withdrawing capacity, which sort of makes it difficult to operate and find capacity partners. So direct to consumer business models, I think, is going to be a challenging space. And for us at least, B2B2C, leveraging affinity partners, distribution partners, is a much better route to market, because not only does it give you the customer access through a partner they typically trust, it also gives you a lot of data that you can leverage to support product development and underwriting. So I think we'll see that sort of shift away from D2C to more B2B2C affinity-led distribution models being successful.
Yes, you are right that B2C is highly difficult. And when you look at the opportunity for growth, when you actually combine in InsurTech, even though that InsurTech may actually put a new product to market with an incumbent, you actually find a much better balance by you going for B2B, 2C or B2B, and leverage everybody's capabilities. The strength of the InsurTech to provide technology and access to market in some ways, and then the might around distribution, knowledge, regulation that the big enterprise has. So Sam, thank you so much for your time. I just would like to ask you now your last words of wisdom for the ventures which are there that need to find funding, partnership, opportunities, and maybe for them to learn from the mites and the big ones you mentioned, that like the Lemonades, which have done very well, are building sustainable business models.
Yeah, I think my sort of closing comment would be, there is a significant amount of capital looking to be deployed to excellent business models. We're certainly committed to deploying funds into InsurTech. As I said, that Series A stage is our sweet spot. So we're always very keen to talk to companies that are either on that path or have reached the Series A stage of the investment cycle. And I think if you look at the market as a whole, we're maybe 10 or at least 10 years behind fintech in terms of our development. So we're still at the very early stages. This is something that's going to be dominating the industry for the next 20 years. It's not a bubble. It's not a passing fad. This is a fundamental change and shift in how insurance operates. We're still in the early stages of what's going to be a super exciting journey.
Yeah, I echo what you say. I've heard many of our partners and other market makers say that we have scratched the surface in InsurTech. We probably have done 1% of what needs to be done. So much more to be done. So thank you so much, Sam. So I'm with Sam Evans, partner at Eos Venture Partners. Sam has shared with us views on the future of InsurTech, how to become and be a partner in a venture capitalist fund, select venture, and build an investment thesis that leads to growth for partners. Thank you, Sam.
Thank you, Sabine.
And à bientôt.
Bye-bye.
If you like this podcast, subscribe now, share with your friends, and if you enjoyed it, please give it a 5-star review. Also, if you want to cover any specific subject with me, contact me on Instagram under Sabine VdL Officials or LinkedIn under Sabine VdL. Thank you.